A new plan to stop Europe's crisis from spinning out of control. It comes to us from BlackRock, the world's largest money manager. With us from London this morning, the chief investment strategist at the BlackRock Investment Institute, Ewen Cameron Watt. Ewen, good morning to you. You have outlined...
Erik, how are you?
I'm well, thank you. You've outlined a four-step program for Europe that goes beyond the so-called breakthrough agreement we saw last month. On the one hand, we're showing it to everybody. Buy more bonds, more details on the bailout fund, forced haircuts on sovereign debt, and credible fiscal discipline. It all sounds great, but why do you think that this will be enough to restore financial market confidence? Because Angela Merkel herself told us yesterday it's going to take more than that. It's going to take a fiscal union and a Europe moving towards political union.
Well, first of all, I think that the fiscal union is wishful thinking in any foreseeable time horizon, and a political union is also impossible in any political time horizon. Angela Merkel can speculate on that, but Europe's not going to be solved in the next 1, 2, 3, 4 years by that process. So, by definition, what we're suggesting is the minimum that's required to stop the output, get the outcome going the other way and becoming really quite unpleasant.
Some of the points that you raise here fall into the no-brainer camp, and some of them are quite a lot harder. Forced losses not only on Greek debt, Ewen, but also on Irish debt and Portuguese debt. What are the haircuts, if you will, need to be forced? Up until now, we've been hearing about the voluntary haircuts.
Well, I don't think the haircuts have been voluntary, Erik, at all. I mean, they're being proposed by, proposed by policymakers. They are agreed gradually under duress by the private sector. Look, we came to a kind of 75–80% level for Greece because, in reality, debt sustainability in Greece is going to be a lot lower than debt sustainability in Ireland by virtue of the structure of the economy. And Portugal probably sits a little bit in between, but it's really difficult to see that a 50% haircut, which was what was proposed in the summit a couple of weeks back, is going to get you to debt sustainability. You have an implausibly high primary surplus for Greece, Ewen, and also for, I think, for Portugal.
Ewen, I understand that. I think many people think that 50% isn't high enough. But you know why, and I know why, they use the word voluntary, even if in reality it isn't. It's because if you force the haircuts, S&P and Moody's, the primary debt rating agencies, are going to declare those countries in default. And that, in theory, would create a chaotic environment in Europe, an uncontrolled situation, which is what everybody wants to avoid.
Absolutely, Erik. But, you know, the point which we're dancing around here is that a sovereign CDS does not give you protection against a default in the sense of a repayment, which is why, you know, the Europeans are trying to avoid a credit event where a CDS triggers. By the way, it's quite interesting to see the EFSF structure assumes that there's a risk of default on the first 30 to 35% of the capital. That's what everyone's trying to avoid, but, you know, it's not avoidable. I mean, in reality, there is a train crash in terms of the debt sustainability, and the markets are eventually going to have to deal with that with, of course, alongside it, more ECB help.
Well, okay, you make an excellent point.
The write-down...
You make an excellent point about the ECB. The ECB is going to have to do more bond buying because none of the policy prescription that you put in here realistically is going to happen tomorrow. Why is it ultimately that you are confident about Europe? Because even in the case of the ECB, we know how opposed the Germans are to the monetization, the indefinite monetization of European debt. Even if it's only for a period of time, so long as the Germans are opposed to it, how can you feel confident that Europe is going to turn a corner?
Well, let's start with the facts, Erik. Over the last 3 months, the European central bank balance sheet has expanded by nearly 20%. So whatever they're saying, you've got to look at what the hands are doing, and the hands have, you know, are doing quite a lot at the moment. Arguably, the ECB balance sheet size relative to GDP is not quite as high as the Bank of Japan yet, but it's a lot higher than, say, the Federal Reserve's balance sheet. But I think that, you know, the truth is the banking system can't fund it itself. It's got to come from somewhere else. If it doesn't, then we really do finish up in a very unpleasant position. So our proposition is that this is the least that's required it may not work, but without it, it's not going to work.
Ewan, good to see you this morning, and thank you for joining us on the Inside Track. Ewen Cameron Watt of the BlackRock Investment Institute.